Over the last 2 days, we've been looking beneath the surface of the financial system. On Saturday, we talked about liquidity, not interest rates or headlines, but the plumbing that allows the system to function at all. Yesterday, we looked at cash and why something that has always felt safe is now being quietly redefined as we move towards 2026. Today, I want to complete that picture by stepping outside the system altogether. Because once you understand how liquidity is tightening, and once you accept that cash itself is increasingly managed, restricted, or diluted over time, the next question becomes unavoidable. What actually sits outside that structure? For most of modern financial history, the answer to that question has been gold and silver. Not because they're fashionable and not because they're speculative, but because they exist without relying on anyone else's balance sheet. Welcome to Money and Power. If you value a calm, evidence-based look at how the system really works, please take a moment to like the video and subscribe. It genuinely helps this analysis reach the people who are asking the same questions you are. One of the most useful ways to understand what's happening now is to distinguish between what's often called inside money and outside money. Almost everything we use day to day is inside money. Bank deposits, digital balances, government bonds, even money market funds. All of it exists as someone else's liability. It depends on institutions functioning properly and rules being followed. That doesn't make it bad, but it does mean it is embedded within the system we've been discussing. Gold and silver are different. They're not liabilities. They're not promises. They don't depend on a bank remaining solvent or a central authority maintaining access. They exist independently of the financial plumbing. For decades, that distinction barely mattered. Trust was abundant. Liquidity was plentiful. Holding assets outside the system felt unnecessary, even outdated. That has changed. Over the last few years, something subtle but important has been happening at the institutional level. Central banks, the very institutions responsible for maintaining confidence in the monetary system, have been increasing their gold holdings at a pace not seen for generations. As we sit here at the end of 2025, many central banks are prioritizing physical gold over sovereign debt. Not because they expect an immediate crisis, and not because they're preparing for collapse, but because global debt levels are now so high that confidence itself has become fragile. Gold in that environment is being repositioned as a strategic anchor. It doesn't yield, but it also doesn't default, and it doesn't rely on confidence in someone else's promise. Silver occupies a different but equally important role. It shares gold's monetary characteristics, but it also sits at the heart of the modern industrial system. AI infrastructure, data centers, electrification, solar energy, all of these trends are physically dependent on silver. Not optionally, structurally. We are now several years into a persistent silver supply deficit. Most silver is produced as a byproduct of mining for other metals, which means supply cannot simply be increased because the price rises. At the same time, industrial demand is relatively insensitive to price. If a company is building a multi-billion-dollar data center, it doesn't pause the project because silver costs more. It needs the metal to function. That combination, constrained supply and embedded demand, gives silver a profile that very few assets have as we move towards 2026. Now, before I go any further, I want to address something directly, particularly for those of you who followed this channel in its earlier years. I'm not going back to weekly price predictions. That was a different phase, a different environment, and frankly, a different kind of pressure. But I also understand that numbers matter, not as promises, but as context. So let me frame this properly. In the environment we're moving into, gold and silver are no longer behaving like short-term trades. They're behaving like assets being re-evaluated by the system itself. From that perspective, prices that once felt high increasingly look transitional rather than extreme. Gold trading well above its old historical ranges is consistent with a world where debt, confidence, and liquidity are being renegotiated. And silver, remaining historically undervalued relative to gold, is increasingly difficult to reconcile with its industrial role and supply constraints. Those are not predictions, they're reference points, a way of understanding where prices sit relative to structural reality, not where they might be next week. And that distinction matters. This isn't about getting rich quickly. It's about staying positioned sensibly as the rules of the system evolve. As we approach 2026, several pressures converge. Debt issued during the low rates years has to be refinanced. Governments are running persistent deficits, and central banks are trying to reduce excess liquidity without destabilizing the very markets they support. That is a narrow path to walk. In that environment, assets that exist outside leverage regain their importance. Not because they will outperform everything else at all times, but because they reduce dependence on the system behaving perfectly. Safety is being redefined. It's no longer just about the number on a screen. It's about flexibility, independence, and optionality. Gold and silver provide that optionality. They don't solve every problem, and they shouldn't dominate a portfolio, but they sit outside the digital plumbing we've been discussing all weekend. And in a world where money itself is increasingly managed, having a portion of your wealth that doesn't require permission to exist is a powerful position to be in. As we close this 3-part series, I want to be clear about what this channel is and what it isn't. This isn't about fear, it isn't about hype, and it isn't about telling you what to buy. It's about understanding where power sits in the financial system and how those dynamics shape outcomes for all of us. If this series has helped clarify that picture, please like the video, subscribe to the channel, and share your thoughts in the comments. I do read them, and they genuinely help shape what comes next. I said I'd keep the Saturday, Sunday, Monday rhythm through the holidays, and I've done that. From here, we move into 2026 with a clearer framework and a better understanding of what actually matters when the system begins to adjust. Thank you for watching, and I'll see you in the next video.